Trading on April 10, 2026, opened with what appears to be broad market strength. The Dow Jones Industrial Average is pushing higher, securing a clear 0.6% gain for the session. Closing at 48,185.8, the Dow maintains a highly constructive technical posture, resting comfortably above all of its key moving averages. This capital flow into traditional sectors is a reaction to geopolitical friction, driven specifically by Donald Trump's pre-talk threats regarding the Strait of Hormuz. Yet, beneath the surface of the Dow's breakout, the broader tech benchmarks, the S&P 500 and the Nasdaq 100, are exposing distinct internal weakness. While both indices closed in the green today, adding 0.6% and 0.7% respectively, their internal momentum indicators are actively flashing crossover alerts. This drag on the indices is not originating from the periphery. It is the result of a structural fracture occurring squarely inside the market's heaviest components, the Magnificent Seven. The headline performance of the broader market is generating a macro illusion, concealing the reality that tech's foundational leaders are actively deteriorating from the inside out. We are entering a phase of market scrutiny best described as an AI midterm exam. Capital is looking past speculative hype and demanding concrete revenue to validate the massive capital expenditures required for artificial intelligence. This intense scrutiny is splitting the mega-cap tech cohort into two distinct tiers: the AI infrastructure providers and the software integrators. On one side, we have the passing tier of hardware and platform layers: Apple, NVIDIA, and Google. On the other side sits the makeup tier, composed of software and e-commerce layers currently weighed down by spending: Microsoft, Amazon, and Meta. This divergence between hardware revenue and software expenditure is immediately quantifiable in the charts. To measure this, we track a specific technical relationship: the positioning of the fast-moving 5-day moving average against the slower 50-day moving average. Tracking the 5-day moving average provides a real-time diagnostic of institutional capital flows, immediately exposing where short-term momentum is exhausted. The Magnificent Seven is no longer a monolithic block. Capital is actively rotating through these assets based on their relative technical strength and the immediate burden of their capital expenditures. The technical criteria for the passing tier is rigid. The short-term 5-day moving average must maintain clean altitude above the 50-day line. Apple meets this standard, pushing up 0.6% to $260.49 and confirming a strong, intact technical structure. Google presents a similar setup, securing a 0.4% gain to $318.49 and holding a bullish posture. Both Apple and Google are demonstrating absolute structural control, maintaining clear daylight above their long-term averages. But within this bullish cohort, NVIDIA represents the most critical and time-sensitive chart on the board. NVIDIA closed the session with a 1.0% gain at $183.91. This dual-line chart plots the precise trajectory of NVIDIA's 50-day moving average at $182.14 and its 200-day moving average directly below it at $180.54. Zooming in on this convergence reveals a razor-thin 0.9% gap, signaling that a major structural crossover is imminent. This bullish technical alignment correlates directly with immediate fundamental drivers, specifically NVIDIA's newly confirmed Xeon chip partnerships to power AI development at Google and Intel. The market is assigning a technical premium to these hardware and platform layers because their AI revenue pipelines are tangible, proven, and structurally confirmed. We must now shift focus entirely to the makeup tier, the software and e-commerce layers of Microsoft, Amazon, and Meta. Microsoft illustrates this weakness clearly, dropping 0.3% to $373.07 and showing severe technical strain. This dual pane tracker shows the core problem for these assets, a condition we call MA5 Special Forces exhaustion, where short-term momentum completely collapses. Despite operating within long-term macro uptrends, the short-term 5-day average is now significantly below the 50-day line. The buyers are tapped out. Meta's daily price action is highly deceptive in this context. It posted a 2.6% daily gain, yet its underlying short-term structure remains severely broken. The force dragging these specific charts down is fundamental. These companies are chained to staggering multi-billion-dollar capital expenditure commitments. Amazon is currently digesting a newly committed $25 billion outlay solely for data center expansion. Meta carries a similar burden, having just entered a $21 billion AI cloud deal with CoreWeave. External competitive pressures are forcing these outlays, underscored by high-profile market participants actively warning about intense competition from AI firms like Anthropic. To defend their market share, these software giants have no choice but to front-load the massive costs of AI infrastructure. While necessary for long-term survival, the market mechanically punishes these charts in the short term as it digests the financial weight of these forward costs. Institutional capital is abandoning the short-term structure, demanding that these companies prove their software revenue can outpace their infrastructure spend before backing them again. That brings us to Tesla, the ultimate outlier in the megacap space. It is currently facing an acute, dual-threat structural breakdown. This localized chart plots Tesla's current daily closing price at exactly $345.62. Just beneath that price sits the critical 6-month support cliff, strictly defined at $337.24. The margin of safety here is razor thin. Tesla is hovering a mere 2.5% above total structural failure. Simultaneously, a secondary long-term threat is unfolding directly above the current price action, the death cross. We can see the 50-day average at $395.96, cleanly slicing downward through the 200-day average at $397.31. If Tesla burns through this final 2.5% support buffer, right as a macro death cross triggers above it, half a year of price structure will be entirely negated. Tesla serves as a strict mathematical warning of what happens when mid to long-term technical deterioration violently collides with a terminal short-term support floor. The market is currently defined by a multi-timeframe divergence, driven entirely by the massive capital expenditure burdens of the AI arms race. For the exhausted tier, Microsoft, Amazon, Meta, and Tesla, the operational rule is rigid. Maintain a neutral, strictly observational stance. The mechanical trigger for re-entry is clearly defined. Do not allocate capital until the fast-moving 5-day average definitively crosses back above the 50-day line. Surviving this specific phase of market digestion requires patience on the sidelines. You wait until the short-term technicals confirm that institutional backing has finally returned to support the fundamental spending.